Hello and welcome to the CNBC-TV18's Mumbai newsroom. I'm Sonal Bhutra. You're watching Mutual Fund Corner. Today we are going to talk about target maturity funds. What are the benefits of investing in them? What this category really is? What kind of returns do these funds give? Can they become a viable alternative? Considering the new debt rules that have kicked in as well. To discuss this and more, we have with us a special guest. Gautam Kaul, the Senior Fund Manager Fixed Income at Bandhan AMC, is joining us now. Gautam, good afternoon. Thank you so much for joining us here on CNBC TV18. Well, you know, there has been a lot of chatter around target maturity funds, a lot of confusion as well. So let's start with the most basic question. Where exactly do target maturity funds invest? What is the underlying here? And how do these funds work in terms of maturity, investment period, yields, etc.?
Good afternoon. Hi. Just to keep it very simple, target maturity funds are essentially fixed income index funds, right? So they have all the features of an index fund, with the additional feature that the target, the index, as well as the fund which tracks the index, has an end date. So there's a maturity date on which the fund expires, and the maturity proceeds are paid out to the investors. Now, how the underlying of these products are typically in three categories. They are government securities, there are SDLs, and there are AAA corporate bonds. There could also be a mix of these three in various options. So as things stand in the market today, there are typically three types of target maturity funds, and the maturities range from as low as 1 to 2 years to as high as 10 to 15 years as well. And you'll find enough and more funds in most maturity ladders going up to 10 years and some beyond that as well.
Okay, interesting. Thank you for explaining that to us so simply. So try to understand more here. How do these differ from recurring deposits? Can these two be treated in the similar manner? Is a target maturity fund a viable alternative to recurring deposits or fixed deposits for that matter?
So while fixed deposits or recurring deposits and target maturity funds do share some common features, I mean, most obvious one obviously being that both have a targeted date of maturity. The other common feature is that along with the fixed deposit target maturity funds, however, reasonable predictability of final return as long as the investment is held to maturity. However, target maturity funds are open-ended debt funds at the end of the day. Therefore, they also have features of an open-ended debt fund. Namely, there is liquidity. You can either invest or exit these funds at a given NAV on any given day. In addition, target maturity funds also have a more diversified portfolio. So when you're investing in a FD or a RD, you are taking exposure only to a certain bank. Whereas in a target maturity fund, it is exposure either to a sovereign issuer like state or central government, or in case of corporate bonds, there are AAA corporate bonds where the limit to a single issuer is restricted to 15%. Therefore, you end up getting a more diversified portfolio, or you get a sovereign portfolio. In either case, your risk is well contained in a target maturity fund. So that is a major point of difference.
Yes, and that's an important point, right? Sovereign backing, you have a fixed return there. Diversification is something that you spoke about as well that works for target maturity funds. Apart from the above that you mentioned, can you tell us what are some of the other benefits of such a category? Why should an investor look at this one?
Well, Sunil, the category is only about 3 years old and has grown very rapidly in the last 3 years. So if you look at the data, in March 21, the category was a little less than 35,000 crores. By March 22, that number had increased to 80,000 crores. And by March 23, it's reached about close to 1,75,000 crores. The number of funds in the category have also increased dramatically. Today, there must be about 95 odd funds offering different variations of the target maturity program. This tells you that there is a reasonable demand for the product, and it caters to a lot of different investor classes. The most obvious benefits, like I mentioned, there is predictability of return if you hold it to maturity. The product is very simple to explain and to understand, and therefore becomes a great first-time fixed income investment for a new investor to the mutual fund space. So typically fixed income people find a little more complicated to understand, but a product which has some features of a fixed deposit and the liquidity features of a mutual fund become a great first-time investment tool for investment in the capital market space for most investors. Along with that, there is obviously the benefit of liquidity. The third benefit, which a lot of asset allocators and sophisticated investors appreciate, is that it helps in goal-based investing. So one can invest money for predetermined periods of time to match the maturity with goal-based. Let's say if you want to buy a house 7 years down the line and you want to keep aside money for that, you can choose a target maturity fund which matures 7 years from now and use those proceeds at that particular point of time. So you have a reasonable predictability of end return if you choose to state a maturity. And it's a fairly safe and diversified option. So the combination of liquidity and diversification, plus obviously the predictability, makes it a very attractive proposition for most class of investors.
And goal-based investing gives a lot of comfort as well, right? So that works for the investors who have a set goal in mind. They can go ahead and put their money here. So let's take that point forward of returns. How do we look at returns in this kind of a category? Many of the target maturity fund investors believe that if they hold these plans till majority, they'll earn approximately the same returns promised at the NFO stage. What kind of returns do these funds give? Because longer duration bonds, they fluctuate more than short tenure bonds, right?
So one feature which to keep in mind for target maturity funds is that since the maturity of the portfolio is already predetermined, as an investor, as you move closer to the maturity of the fund, the duration and therefore the volatility and interest rate risk of the portfolio decreases in a linear fashion. Right? So if you start with a target maturity with the initial maturity of 5 years, 3 years into the life of the fund, the residual maturity will be only 2 years, and the consequent volatility due to interest rate movements will be much lower than when you first started. So the point number one is that the rate volatility is linearly decreasing, unlike other open-ended funds where, depending on the view of the fund manager, the duration of the portfolio could go up and down, and therefore the volatility could be a lot less predictable. The predictability of the return, as is often touted, works when you hold this investment to maturity. Just one point to keep in mind, like most any bond investment, the target maturity funds YTM have an inherent risk that the reinvestment of the coupon is at a rate which is not yet known today, which is why you will not probably get the exact YTM. There should be some slippage from coupon reinvestment, but it typically is not a lot, which is therefore the predictability rate is still fairly high.
Okay, also, that is an important.
Yes, and
please go ahead. Please go ahead.
Sorry. Also, the other thing is that during the life of the fund, being the nature of an open-ended fund, there is a daily NAV, and there have been periods of both interest rates going up and going down. So, for example, if rates go down during the period of the fund, the MTM gain reflects in the NAV, and the exit can be made at a profit within the lifetime of the fund as well.
Okay, that's an important point. Thank you so much for highlighting that as well. So now that we are talking about interest rates, and that is something that will impact returns as well for investors in this category, how are we looking at this one considering the interest rate cycle that we are in currently? RBI did not raise rates this time around. What is your take?
So we believe that rate cycles in India have peaked. And if you look at it even in a broad global scenario, most major economies are either at peak or close to peak of their rate cycle as well. In fact, if you look at the US Fed futures market, the market is already pricing in rate cuts by the end of this year. So in such a scenario, high quality fixed income allocations are ideal. Investors typically should look to increase the duration of their investments to take advantage of these higher yields. And if there are investment allocations to be done, target maturity funds, like I said, provide a very simple, cost-effective way of doing that. And in addition, you get to choose your investment horizon as well.
Okay, all right. So that is the take considering the rate hike cycle that we are in, and what are you expecting in terms of rate hikes or at least rate action going forward as well? Gautam, this is a very interesting chat. We'll continue that on the other side of the short break and learn more about target maturity funds and the outlook going forward as well. Stay tuned for that. The
pursuit of inspiration, empowering visionaries to drive innovation. The pursuit for enduring growth, honoring game-changing achievers. The pursuit of unmatched legacy. 18 years and counting. The CNBC-TV18 India Business Leader Awards, as prestigious as the leaders they honor.
Standard Chartered presents India Business Leader Awards, a legacy inspiring excellence, in partnership with Hindustan Times.
Welcome back. You're still tuned into MF Corner, and we have with us Gautam Kaul of Bandhan AMC. We're talking and understanding everything about target maturity funds. So far, we've understood where they invest in, what kind of returns that do they give, what are the advantages, and what should be an investor's viewpoint considering the rate cycle that we are in. Now that we've understood all of that from you, Gautam, can you give us a sense of how much of one's portfolio should be dedicated to such a category? After the removal of indexation benefit for the debt category, is this still an attractive bet?
Well, I think the investor, when making an asset allocation in a multi-asset framework, should look at fixed income as a core part of their investment. And within that space, I think target maturity funds definitely serve a need. Like I said, for goal-based investing, it's a wonderful tool. For first-time investors who want predictability of returns and are not looking to liquidate in the interim, it's a wonderful product. And as far as the change in taxation goes, while it changes the post-tax return for investors, I do not think it changes the risk appetite for any investment portfolio, right? So your asset allocation is a function of the kind of risk that you're willing to take. And we don't think that that risk should change simply because the taxation has changed or your post-tax return has dropped. An approach which focuses on risk control, I think, works better in the long term than rather than trying to improve your returns by cranking up risk. Because in the long term, what will happen is that you are comfortable holding a portfolio where you're comfortable with the risk. Right? So what the change in taxation has done is it's put most financial instruments on the fixed income side at equal footing. I think it's good for the long-term investor. The investor can now evaluate all these instruments at their merit, look at whatever benefits they provide versus the competition, and choose what suits them best. And in that comparison, I think target maturity funds still hold up pretty well. The combination of some FD-like features like predictability of returns, plus liquidity and diversification, I think still make it a fairly good option for fixed income allocation.
Okay, take that point. So in that case, what would your sense be? Will pure debt funds or target maturity funds be still better than fixed deposits despite whatever we've seen right now in terms of taxation regime change?
Well, Sonal, that will depend entirely on where we are in the rate cycle, and beyond that, what individual banks offer versus what the capital market offers. So there might be times or periods in the rate cycle or during the financial year where investors find that FD rates are better than what target maturity funds offer, and they are not looking for that liquidity, in which case it's a fairly, it makes all the sense in the world for them to employ some money in FD as well. However, my sense is that the combination of liquidity as well as the market rates that offer will at most times compete well against high quality FDs. So they should both probably find their respective space in an investor's portfolio. And within that fixed allocation core bucket, both will find their own space depending on the rates being offered.
Okay, that clarification is important. So Gautam, in that case, can you suggest what would be the reason for someone not to invest in target maturity funds? What are the disadvantages, or what should they be looking at before they look at this category?
I think the only major disadvantage, so to say, is comes as a flip side of the advantage. The predictability that the target maturity fund category offers is because there is a known date of maturity. Now, the problem there is that in case it's a goal-based investing where the capital is to be used somewhere else, then it's fine. In case you're looking to reinvest that capital back in the fixed income market, you do not know what the rate of interest at that point will be. In other words, there is a reinvestment risk. Right? In case of an open-ended mutual fund which runs to perpetuity, that risk is not as evident. But in a target maturity fund, because the portfolio declines in a linear fashion, reinvestment is a major risk. The other thing is that if liquidity is required at a given point of time before the maturity of the fund, then your exit is at the market rates and the NAV that reflects the current market rates. So that could differ from what is the final YTM expected from a initial investment. I'm sorry, what was the other question?
No, exactly this. What should be kept in mind while you're investing in target maturity funds?
Broadly, these are the two things to be kept in mind. The other, like I mentioned, there are now 95 funds in this category. So all target maturity funds will not be same. There will be some which are predominantly government securities dominated. There are some which invest predominantly in SDLs and some which are completely AAA corporate bond dominated. So the investor should look at the underlying portfolio, the kind of allocation they are interested in. There are investors who are looking to do only government securities. There are investors who are looking for an extra carry and therefore might look at SDLs or AAA corporate bonds. The thing to keep in mind from our view is to look at the additional spread offered via going to SDLs or AAA versus the GSEC portfolio. And second, the maturity tenure. If it makes a lot of sense to stick to your investment horizon and not go away from it on either side. So if you're, for example, if you're looking to invest for 7 years, you might invest in a target maturity fund which invests in 3 or 4 years, but that leaves you exposed to reinvestment risk. Similarly, if with a 7-year horizon you invest in a target maturity fund which is, let's say, 10 or 15 years, then you are leaving yourself exposed to a mark-to-market risk. So keeping in mind your goal, it will make sense to match your investment horizon with a target maturity fund. That there are more than enough funds available to meet most investor needs.
Oh, yes, absolutely. You mentioned that at the start of the show as well, right? How this category, despite being just 3 years old, has seen a massive increase in the kind of flows, the AUM and the number as well. Gautam, it was a pleasure speaking with you. Thank you so much for joining us today and explaining us all about target maturity funds. That was a masterclass. Hoping to speak to you very soon yet again. Thanks a lot for joining us.
Thank you for having me.
Okay, all right. With that, it's a wrap on this edition of MF Corner. But do remember to email us your queries and we'll address them with our experts. Leaving you with some market opinion from Krishna Kumar Karwa, Managing Director at MK Global. Stay tuned for Closing Bell to take you through the last hour of trade.
Banks have given very good numbers, but the question is that are we looking at peak in terms of the bank's profitability, credit costs, etc. And going forward, or in the next few quarters, or maybe 2-3 quarters down the line, how do you expect the banks to perform? My question is that yes, numbers have been very good for banks, and banks have recovered from their lows in the last 30-45 days. But in terms of valuation multiples, will we see any expansion of further valuation multiples, or are these most of the banks now getting into a territory where they could be kind of earnings compounders? Not seeing too many earnings upgrades across the board. Most of the time, I mean, the numbers have been good, but are analysts upgrading their numbers? Except maybe in autos, we did see upgrades coming up, and maybe in cement also. Replacement cycle is picking up, and that should be the reason why you will see possibly all the two-wheelers delivering good numbers. As far as commercial vehicles are concerned, possibly this quarter may be the peak in terms of the numbers, and maybe there is a slowdown that we expect in commercial vehicles. Some of the companies have delivered also on numbers, and market is also looking at them positively. So there are opportunities, valuations have become attractive, and if you feel that there are some winners in the segments, then they should be invested in. A few of the companies have started attracting a lot of investor interest. So yes, not to ignore them carte blanche, but independently, I think they should be looked at.